I guess let's start on the jobs data. Really hot print here in the US for January. You know, the logic here, I guess, from the market's reaction is the Fed will have to rethink about the timing of a policy pivot. And then in the context of higher rates discounting present value, future profits, tech, etc., is this a think again moment, or is this just a blip?
Well, I guess we're back in the zone where good news is bad news. I think that the market reaction was pretty predictable given the much hotter than expected non-farm payrolls. But as you pointed out in your opening segment, the market's been up 5 weeks in a row, and the NASDAQ, which is obviously highly sensitive to interest rates, is set to close up, or I should say recently just closed up over 3% for the week. So I think we were probably due for a pullback after a pretty blistering hot period. And as I see it, I don't think the number today, as one isolated data point, is enough to derail this risk-on trade that we've seen pick up the last little while.
So you yourself personally do hold Apple, Amazon, Alphabet, the parent company of Google. I think you also hold Microsoft as well. As we reflect on the week of earnings, one of the takeaways that other guests have said is that essentially this is definitive proof. Mega cap tech is not immune to what we see in the global economy. Was that your takeaway as well?
Well, I think that's been obvious for the past few months. I think going into 2023, investors had really been pricing in the worst case scenario for the start of this year. I think expectations were that inflation was going to keep running hot, and that was going to force the Fed and other central banks to continue to jack up rates, and that we were going to be due at some point for, some kind of economic slowdown, maybe even a major recession. So far, the data has not borne that out. Now, I wouldn't say that we're out of the woods yet, but I think that the worst case scenario is really no longer the base case. And I think a soft landing went from something that was kind of a pipe dream for a lot of bulls to something that's increasingly being priced into the market. And when that happens, I think that that's obviously going to cycle capital back into stocks. I think a lot of managers started the year very underweight, looking to wait and see how the Fed reacted. And you get this FOMO at the beginning of the year, as simple as it might sound, where they have to play catch up to make sure they don't miss their benchmarks. And I think we're starting to see that trade playing out too.
Right. There's this idea of tough comps, right, or unfair comparisons between Q4 22 and Q4 21. Apple was a good example of that in their commentary around the difficulties they had in the last 3 months of 2022, but also the idea that it wasn't fair to compare with the period a year ago because of the different product release timings. How good was Q4 21 compared to what we saw in the most recent earnings period?
Well, as you pointed out, every company is different. And in Apple's case, the product cycle can weigh on earnings and on revenue. But I think in general, Q4 2021, so a little over a year ago, was kind of like the Goldilocks zone. We had all this deferred consumer spending because people had been locked up during COVID. You had an economy that was still growing at a very fast clip, and the inflation concerns weren't quite as, acute, I guess, as they are today. And so you saw that transferred into consumer spending, business spending on advertising, spending on cloud, and so forth. That translates into the earnings for these companies. So I would say that looking at, most investors were looking at this earnings prints from these different companies, hoping to avoid the worst. And to be clear, tech earnings were mediocre, and I would say kind of a mixed bag. Facebook beat on earnings and revenue, but had exceptionally low expectations. Apple, as you pointed out, mixed on both. But ultimately, we're comparing it to a period that was, if not an outlier, very difficult comp compared to what we saw last year. And B, I think that really people are trying to look forward to see what these companies are going to do to try and right the ship. And yes, please go ahead. On that note,
how zeroed in then is this market on the bottom line? When we talk about what we learned from earnings about 2023 going forward, the answer seems to be not that much, other than they're zeroed in on cost.
Yeah, well, in a zero interest rate environment, it's a grow at all costs kind of market, right? And that's why you saw, unprofitable tech companies trading at sky high valuations. And that was true also for big cap tech companies. And I think we're starting to migrate from a top line market to a bottom line market. There's an increasing focus on cost, all the inputs that go into, the financials for these companies. And as you've pointed out, there have been some job cuts and some other trimming. And I think if you look at the earnings calls for these companies the past week and a half or so, that's something that they've really drilled down on. And I think investors are pricing that in. They're thinking, okay, well, if they can keep cutting costs, even if revenue is flat, then I'm going to see bigger earnings, and I want to buy into that trade.